thank you very much, Kim, for coming and spending some time with Intanify. Good morning.
Hello, Dylan. I really appreciate the opportunity to chat with you today about our mutually favorite topic.
Yeah. So you've had a long and fairly varied career in IP and a little bit outside. So I thought rather than me potentially butcher it, I'll ask you to introduce yourself as a point of departure.
Sure. I'm the global lead for WTW's Intangible Asset and IP Risk Management practice. And really, our goal is to help our clients understand, assess, and quantify the impact of intangible asset exposures on their businesses, and to provide risk management and financing options for this area of risk. And as you said, a little bit of a varied career, but I've been focused on this risk area for the last 24 years. I've certainly seen various insurance products develop to address intangible asset and IP risks. And we can talk a little bit about the pros and cons I've seen along the way. But yes, so I've helped develop insurance products. I've helped place them. More broadly, I've been involved in litigation risk management in the intellectual property space, and in licensing and monetization of intellectual property assets.
Cool. Well, pretty much everything, it seems. And what were the insights that led you? Because I know your products, the intangible asset protection product, is properly unique. There's nothing else like it, which is how I guess we came to meet. What were the insights and the kind of needs that you saw in the market that led you to develop something so different?
Yeah, I'd say there really are two areas where the insurance industry has fallen a bit short when it comes to this category of risk. One is in protection of the intangible assets themselves, sort of that first party property risk, if you will. And the second is in being overly focused, I think, on legal events and not on other areas of exposure. There are a lot of things that can happen to intangible assets, not just legal events that impact intellectual property rights.
Cool. Do you want to give an example of that, actually, just to make it a bit clearer?
Yeah, so for example, what we largely have in the market right now is, and I can talk a little bit more about this later, but is intellectual property infringement liability insurance.
Yeah.
So in the insurance world, we talk about property risk and we talk about liability risk. So if you buy a homeowner's policy, it's going to protect you if your house burns down, something has happened to your property. It's also going to protect you if someone is on your property and they slip and fall and hurt themselves. And they, sue you for their personal injuries. So with intangible asset exposures, you have both sides of that coin as well. You have things that can happen to the assets themselves. And then you have risk associated with trespassing on someone else's intellectual property or intangible assets. So that in the insurance world, we've been better on the liability side than on the property side.
Yeah. And that's the key kind of insight, that most of the IP insurance is really protecting you against someone coming after you, or the need for you to go against someone else, versus actually my asset. Maybe you could give an example of something like intangible assets, say data, or a trade secret. How might that actually get harmed?
So you just like tangible assets, intangible assets can be lost. Someone leaves their laptop with key proprietary data on it on a subway train and it gets lost. Okay, you haven't just lost the laptop, you've lost the data inside the laptop, but your insurance policy won't cover the loss of that data. It's only going to cover the loss of the laptop. Intangible assets can be destroyed. You can have a disgruntled employee who says, you know what, I'm going to corrupt this code base before I leave. And it's the only copy of that code base you have. So it's going to cost you money to rebuild that code base. you can just damage an intangible asset. So again, employee makes a mistake. They've corrupted some of the data that you've been collecting. Now you've got to redo your research. That's going to mess up your R&D budget.
Yeah.
And then finally, the piece of it, couple of pieces of it that are a little different than with tangible assets. One is this concept of leakage or disclosure. So if you have something like a trade secret or other corporate confidential information, and let's say that it's an algorithm and the software for that algorithm is put in the wrong GitHub repository and a hacker gets hold of it. Okay, that causes you financial loss, right?
Yeah.
Or you have an employee who leaves with trade secret protected information and they take it to a competitor. So that is a disclosure to a third party of something that was supposed to remain secret.
Mm-hmm.
Now, the other piece of it is intellectual property rights are just legal ways to protect intangible assets. Patents protect inventions. Copyrights protect creative expression. Trademarks protect brands. But because you have those legally protected rights, you can bring legal action to enforce those rights against those who have trespassed on them. So just like with real property, someone trespasses on your land. If someone uses an invention without paying you a license fee for doing so, they've trespassed or infringed, and you can bring legal action against them. Those legal events are largely what has been insured through products available in the insurance market.
And why do you think that is? What is the challenge in it almost seems glaring in being missing, considering that's how most insurance works. What were the challenges?
Well, I think there are a couple of things. I'd say one is that, especially if you're looking on the first party side, what I've seen with past products is, I've seen products, for example, Kiln way back in the day had a product that Robert Chase developed, and it was supposed to protect patents if they were invalidated. Again, a legal event, right? But even there, then the devil was in the details, because on the front end, the insurer said, well, we need a value for those assets. So we know how much to insure them for, and because we don't want to over-insure, just like, over-insuring a house, against fire. And so that required going to a valuation expert to get that valuation. Those valuations are very expensive, as you know. And that was one, frankly, hurdle. The other hurdle was their 3-year policies, but they required that the patent had to be fully and finally invalidated, like go through all the appeals and everything else before the policy would pay out. Well, legal systems don't move super quickly. And so people would say, yeah, but we may not know in 3 years. So that was some of it. I think another is just that, especially during the dot-com era, and then when the dot-com bubble burst and folks started acquiring these patent assets, that you saw an uptick in litigation. That's when you had the rise of the so-called patent troll. And so there was this big focus on how do we prevent all of this litigation from happening, especially in the US. So I think, and then finally, because we're just now hitting the digital age, it's just been in the past few years where we don't have the Coca-Cola recipe. Well, they probably still do, but the Coca-Cola recipe on a piece of paper in a vault, right? It's digital. And data has value now in a way that it never did. So I think these are some reasons. Final reason is, speaking of data, there's not a lot of data. And we found this when we were developing our intangible asset protection product. There's not a lot of data on these other things that can happen to intangible assets, because no one's required to report them. And so with litigation data, at least now, most of those court databases are public. So you can go, and at least from a frequency perspective, you can see, well, how many patent cases are filed in the US every year, for example. Now, severity is still an issue, but we have insurers who've been in this market long enough that they do have some of that severity data too. But that is another reason I think that you see the insurance world being, a little behind in terms of providing protection for these other types of events that can happen to intangible assets.
And that would have been to help to price the insurance. You don't know, for example, leakage and trade secrets being maliciously harmed and so on. Okay. I guess the other thing which you and I have talked a lot about is companies actually just not knowing what they have, broadly knowing what they do, of course, otherwise they wouldn't be great companies, but not actually having in years gone prior, you would have had a fixed asset register and would have said plant, property, and equipment. That would have all been on your balance sheets when it comes to making financing decisions, and you were seeing what you were, which financing option might be the best. You would have looked at your assets, you would have looked at your cash flows, you would have looked at various options. And equally, I guess, with the insurance, everybody insures still to today, the table and the laptop and the subway and so on. But because there isn't a list, they might not think of insuring. Is that's something that you've seen as you've been marketing the product? Perhaps you could just talk a little bit about that, because these are very big companies that you speak to. It would almost seem surprising that they don't.
Yeah, it's really interesting because, and we could talk a little bit about our product, but we are largely talking to companies in the tech, media, telecom space, life sciences, niche manufacturing, and it's interesting because they can readily produce a list of issued and pending patents and trademarks. Often they can at least provide a list of copyrighted materials. They may not have a registered copyright, but they can pretty much tell you, what they consider to be copyrighted. Sometimes it's a little more challenging for them to identify all of their copyrighted software code. And then finally with trade secrets, it's a mixed bag. Some are a little, they can identify the more obvious ones. But the reason for that, and the reason they can readily produce that list of patents and trademarks, for example, is because there are tools available to track and inventory those legally protected intangible assets, the patents, the trademarks, right? There's lots of software tools out there, and you use them to track, activity with the patent and trademark offices, et cetera. Now, as you know, more recently, tools have been developed to help companies inventory some categories of trade secret protected information because they did see the need. And so there's 2 or 3 tools that, I know of, and there's probably more than that. Where the challenge comes in is sort of the broader, corporate confidential information and broader thinking about, well, what about key contracts, key FTC kinds of contracts or franchise agreements. What about how your software is put together, how the development stack works? What about some of your key, like I have clients in the tech space who have pretty complicated tech stacks, and they're working a lot with data. Some of that data they're licensing in, and then what is protectable is what they then do with the data and how they do it, as opposed to the data itself, because they don't own the data itself. They're licensing it from a third party. So it gets a little tricky. And so, yes, what we're finding is clients love the concept of our insurance for protecting their intangible assets, but but they have to schedule those assets onto the policy, just like you would like a fine art policy or a jewelry policy. And when they have to get down to the nitty gritty of adequately describing and deciding which of those assets, especially since we're focused on the non-public proprietary assets, they're challenged, definitely challenged.
Yeah. And they are not required by your policy to have valuations against those. It's actually just in the first instance having it all down. Simple as that, or not simple.
That's right.
Yeah.
We really, because we saw that again as a hurdle. And because, often you've got an intangible asset that indirectly contributes to revenue, right?
Yeah.
And so the way that we looked at it, and just to back up for a minute, just to kind of provide some context. So IAP is meant to safeguard those non-public proprietary intangible assets, as I mentioned. And while we have a product roadmap and we want to keep, adding to the coverage, this initial version that is in market is to protect those assets against financial loss caused by insider actions. Because, a couple of reasons that we focused on that first. Well, first of all, as you yourself have noted, less than 20% of intangible assets are insured. So we've got a lot of white space there. Something else we found is over 90% of companies are concerned about insider risk. And so again, that's not really an exposure that's currently covered. So we looked at insider risk and we broke it into two pieces. Well, really three pieces. So first of all, the insurance covers $1 million worth of investigation costs. And this is to determine, okay, we've had an event, for example, a cyber event, a security breach. We don't know if any of our assets have been affected, and of those, if any of them are assets we have scheduled onto the policy. We don't know if what happened was accidental or malicious, or if it was external or internal. So this $1 million gives you the ability to hire computer forensic folks. If you suspect an employee, it allows you to hire outside counsel to run the investigation due to the sensitivities. Second piece of it is if you determine it was a malicious insider, and whether they took something and left and went to a competitor, whether they damaged an asset, whether they destroyed an asset, you've got up to $2 million to pursue some type of legal action against them. So just a real quick aside here, because we talked earlier about, what's currently in the market in terms of, you can purchase IP enforcement insurance. That's nothing new. That's been out there since the late 90s. It's really a form of litigation funding, but it's very narrowly focused. So they'll say, okay, if we decide you have a viable case, then we will cover your legal costs to pursue patent infringement, trademark infringement, copyright infringement, or trade secret misappropriation. That's it. No other causes of action. Our coverage is a little broader than that. It could be breach of an NDA. It could be destruction of company property, et cetera, not just trade secret misappropriation. And finally, the last piece, and this is why I kind of backed up to provide this overview to get back to answering your question. The last piece is probably the most different from anything that has been seen in the insurance world before. And that is for accidental insider events. That's basically employees making mistakes, being negligent, right? In which results in a disclosure or a destruction or a damage or a loss of a scheduled intangible asset. So what are you going to get for that? What you're going to get is, if it was an asset contributing to revenue or whether that's directly or indirectly, you're going to get lost income. If it was an asset under development, and so now you've blown your R&D budget, it's going to give you redevelopment costs for up to a year. In this regard, it works almost more like a business interruption coverage than, the value was this, so we're going to pay you this. So the way we developed our underwriting model is we request revenue information, or if it's asset under development, what's your R&D budget? What have you spent to date? So not unlike some of how your tool works. So we're looking at that. We're doing an average of what a year's worth of income would be and calculating it accordingly. So it's not so much on a value basis. Eventually, we'd like to get there, but right now there's just not enough there because kind of to your earlier point about, PPE being all on the balance sheet, in the US under the current accounting rules, intangible assets are not on the balance sheet unless they are acquired assets.
Yeah.
So there's a big piece that's not there, right? And hasn't been valued.
Almost all of it. And it's the same in Europe as well. It's goodwill. And then if you did file a patent, so we've got on our balance sheets £400 because that's what it costs to file a trademark, which has obviously got absolutely nothing to do with the value of the brand. But it's silly. So with valuation, I know that you worked at some of the really big firms, and you're skeptical on valuation a little bit. Maybe you could just tell us why.
Yeah, so I was at Duff and Phelps and I was at Kroll, as and part of the group that did valuations for companies, and I was often involved when those were valuations of intangible assets. I think that accepted valuation methodologies have limitations. And they have to make a lot of assumptions. They're assuming a patent is valid. They're assuming the trade secret was kept secret, right? And as we already mentioned, accounting standards in the US only require that, the acquired intangible assets be on the balance sheet. And then the other thing is volatility. The value of intangible assets really can swing wildly. And, from, let's say that it's a patent on, a potential life-saving drug, for example, it's not going to have much value until that drug is in market, right? And then, I as a baby lawyer, I cut my teeth on not the 2008 financial crisis, but the financial crisis of the late 80s, early 90s with the banks and with real estate, did a lot of foreclosures, et cetera. And what you sell something for in a fire sale is very different than otherwise, right? And, so you have to look at what am I valuing these assets for, right? So it's I think those are just some of the challenges, right? It's especially when you're trying to develop an insurance product around it.
And a lot of those I think are similar to other types of assets, though, to be fair, in terms of it might have a lot of value, but then it has no value the day after if your competitor brings out talking about that life-saving drug, if there's a better life-saving drug, but that's not dissimilar to technology products and other types of things. I think what we see a lot of is the industry, the incumbents obfuscating and saying, sure, it is complicated for sure, but you can also make it a lot more complicated by sharding things and having difficult methods where all valuation actually just comes back to cash flows, to margins, to revenues, to growth. And, the further you move away from that, the more you obfuscate. I think, sure, the more you can charge as an expert, but then also, almost the less useful it becomes. So that's what we've done is really make things very, very transparent and very, very directly attributable between how I make money, what I make the money worth, type of thing. So
that's
we'll see.
that's definitely what we try to do as well. I mean, I think we have a little ways of going, but that's really important because I know, I mean, when I worked at Pius, which provides collateral protection insurance for intangible assets, I had Joe Aggiato, who started Pius, came from an accounting and valuation background. And, we had a lot of debates about this and he looked at it very similarly to how you do. What's the revenue attributable to it? Can you document that? But also, what is the value of the intangible asset relative to the overall enterprise value? He looked at it much more from an enterprise value perspective. And, is this 10% of the worth of the company? Is this 25%? So I think that's helpful as well.
Absolutely. Something I wanted to ask you about is, so my co-founder, our CTO, spent a lot of time banging on boardroom tables about cyber risk and cyber insurance, in kind of a couple of years gone by. And everybody, politely asked him to stop banging on the tables and leave the room. Of course, now this is the #1 board issue, and more and more every day. And it's his very strong belief, which of course means it's our belief, that same thing will happen to IP risk. So you see a lot of surveys. Deloitte did a really big one about attitude to risk and looking across organization and so on. And a lot of these issues are not even really kind of on the C-suite. They're kind of buried in, and then perhaps lost between the general counsel and perhaps the CTO's office and somebody else's office. But if we're saying that these are attributable for 90% of the value of a company, it seems to us crazy that there wouldn't be board level issues. Wondering what you see in that respect with the potential for IP risk and IP insurance and intangible asset insurance to follow the path that we saw with cyber.
Well, as I said, I've been at this for 24 years. I've been an attorney for 36 years. I mean, I'm a grandmother at this point, for God's sakes, and I keep waiting. I remember writing articles in the early 2000s about how this was a board level issue. And, I'm like, when's the other shoe going to drop? Now, I think the other shoe is about to drop. And the reason I say that is because we are now in a digital, cloud-based data and software-driven world. No matter what industry you're talking about. And the speed of change continues to accelerate, and human capital is becoming more and more transient. So I'd say nothing is completely safe. Just like they discovered with cyber, right? Eventually, the CISOs and the CTOs had to throw up their hands and say, okay, we need cyber insurance, because no matter how good of a job we do, that risk is not going to be taken to zero. So I'd say nothing's completely safe and the stakes are higher. And when you have those two things, and you have some interesting regulatory changes as well, right? With some of the SEC rules, we'll see what happens with the non-compete rule in the US, but I think some of that will, because even with these SEC rules on cyber, they didn't say only if that impacts, personally identifiable information. Right? They just said if it's a material event.
Maybe can just real quick for non-US people, you could just explain that ruling real quick.
Yeah, so and I'm no expert. We've got folks here who are, but it's basically saying if you have a cyber event and you believe it's material to the business, then you have to report it within a certain period of time. It goes into your public SEC filings, which a lot of companies were already doing, but now it's mandated. And there's a quote from Chair Gensler that a lot of folks have been using, but I think it's very apropos, because he said, this is no different that when you're talking about millions of files being lost in a cyber incident, he's not specifying that those are only personally identifiable or personal health information. He's saying files of the company. And now these are digital files, right? So it means the company's own information, which includes corporate confidential information, could be impacted and could be material to the business. So that means that the financial impact on the company isn't just about paying a fine. It's the loss of valuable assets. And sometimes, you need forcing functions like a statutory or regulatory change. And this may be it. I mean, why do people buy D&O insurance? Because they wouldn't get anyone to be a director or an officer if they didn't.
Well, that's it. Not just you've lost something, but the markets will judge that you've lost something very, very quickly. And markets are smart. So they will say, well, those files were all of your trade secrets. I happen to know how you make money, and it's using those. So that's probably materially harmed your ability to earn money forever. I can't remember who it was, but somebody was saying that every single night at 5 o'clock, all of my IP walks out the door. and then at 9 a.m. it comes back kind of the next day. So I mean that is
You
really
hope.
true, isn't it? Yeah, well, you hope, yeah, you hope. Generally they do, but yeah, depends on what kind of a culture you have. Any other expectations you have for IP and the industry generally in the next few years?
I think this whole concept of what you own is morphing. So
Yeah.
you talk the example you just gave. You know, the younger generation looks at things a little differently. And you know, if they've worked on code and a friend of theirs who works somewhere else has helped them with that code, they don't it just doesn't compute to them that, oh, but I can't touch this. It's got to stay at the company. The company owns this, even though they sign the agreements and do all that kind of thing. I think that, and AI, you know, AI is going to definitely have an impact. AI is just a tool. It's software, right?
Yeah.
But there's all kinds of risks related to that. And what's AI doing that an employee did before? I mean, there are going to be a lot of these are still unknowns.
Yeah.
Which is usually where insurance steps into the breach to hedge against those unknowns, right? But I do think I wasn't kidding when I said one of the key pieces is the transience of human capital. People don't stay at companies for 30 years anymore.
Yeah. And if all the values in their heads, then how do you protect that? How do you maintain what that is? How do you ensure it's, at the moment, none of it's been done, and that will just necessarily need to change. And the other way it'll change, even if it takes longer, is that the companies that don't do it, they will just die, unfortunately. And the companies that do a better job of it will, you know, be the Nvidias and so on of tomorrow. So cool. Well, I think that's a good place to end. Kim, thank you so much. That was a really enjoyable conversation, and we're going to look forward to continue talking with you and hopefully growing our businesses together.
Definitely. Thank you again.